Michael, how have your professional and personal experiences, how do they lead you to authoring this book?
I spent the first 13 years of my career as a lawyer. So I went to law school and practiced at a great law firm, which had been called Hale and Dorr and is now called Wilmer Hale. It's one of in my opinion, one of the best law firms in the world. And I was a tax partner there. And as I said, I practiced for years. And one of my favorite things to do as a tax lawyer was to focus specifically on serving executives and entrepreneurs. And for me, that took the form not only of doing exotic things like mergers and acquisitions and spinoffs, but it was also about looking at executive compensation, looking at equity incentives, incentive stock options and employee stock purchase plans and restricted stock units and deferred compensation structures and serving clients in that way as well. And for me, when I came to the Colony Group, it just so happened the Colony Group had already expertise serving executives and entrepreneurs. It seemed like such a natural progression for us to continue to get into this world and to ultimately write a book about it.
Jeff, what was the goal in writing this book? Was there any particular mission you were hoping to accomplish through writing this?
Yeah, I think, and Michael will speak to this as well, but I think you hit a little bit on it already, Emily. And I think, there are a lot of financial how-to books out there, but we were trying to do something a little bit different. We wanted a book that just reads a little bit easier, like a story where you get to know some characters and what they do right, what they do wrong. And then instead of just having a list of the best financial strategies that are out there, we try to relate them back to David and Abby's life. Mm-hmm. So I like how each chapter begins with a little excerpt from their story to remind the reader how the chapter applies to the couple. And in the end, there's even an alternate story where they work with an advisor, Delilah, and do some goal-based planning and how that changes their lives. So I think we were trying to engage the reader a little bit more than the dry financial books.
I imagine that not only does that keep the reader's interest, I know it kept mine, but it probably makes a lot of these lessons really more ingrained in your brain. I feel like when you see how something works, you actually can follow that a little bit better.
I think that's right. I think it's about application, and it's helpful to use a story motif because it does keep people interested. And I will just say that, just getting back to the question you asked, Jeff, we did a lot of research before we wrote this book, and we did find a book that specifically addressed planning for executives that was published about 30 years ago. And we did not find anything else. So to our knowledge, there are no other books specifically focused on financial planning for executives and entrepreneurs. And that's really an important thing to be thinking about, which is that we believe planning should be specifically focused on the type of person, the needs that they have, the specific needs that they might have relating to their profession or to their own personal circumstances. I read something recently where someone was criticizing the use of the term personal in front of financial planning, not in the context of our book, but in the context generally of people talking about personal financial planning. And I'm not sure the author of that article fully appreciates that when we say personal financial planning, what we mean is specialized for that particular person. Of course, all financial planning is directed at people, but what's different about this type of planning is it's specialized and focused specifically on executives and entrepreneurs.
And why did you guys want to focus on executives and entrepreneurs? What was the reasoning behind that?
I'll pop in there. For me, and I've been advising, I was a tax partner at Ernst & Young for almost 2 decades. So focusing completely on executives and entrepreneurs. And to me, what was devastating was what happened in the .com era. Mm-hmm. And I saw neighbors and friends and even colleagues make devastating mistakes, permanent, complete loss of very dear capital to them. And in fact, I started writing some of the most boring chapters because I just felt like this can't happen again. And so, we want to stop the mistakes that really can cost people dearly. There are opportunities and then there are mistakes.
Mhm.
And we're hoping that this book helps that situation.
I mean, I think it should. It definitely should. I know this is the second edition of the book. That's correct, right? So what has changed from the first publication, and why was now the time to publish a second edition?
Yeah, I'll jump on that. Others may have things to add. First of all, the world of financial planning is always changing, and we needed to do some updates. The world of taxation had changed a bit, and some of the regulatory structures had changed. And we wanted to make sure we were addressing those changes. But the other thing that I would say is that we knew when we published the first edition that there was going to need to be a second edition, because we had so much to say, and yet there was more to say. And we wanted to get out our first edition. But what was missing from the first edition was a more detailed discussion of concentrated equity positions. And actually, Dina led the writing of that chapter, I believe, along with Matt Ilteris. I think they were the principal authors of that chapter. But we knew we needed an entire chapter that could help executives and entrepreneurs deal with the concentrated equity positions that they've built up in their companies. We also knew that we needed to have an entire chapter, a new chapter, devoted specifically to planning for liquidity events, whether those are sales or mergers or acquisitions or other dispositions, other things that give public offerings that give executives and entrepreneurs liquidity. And we needed a chapter on that. And my partner, Max Haspel, and I worked on that chapter, again, along with input from others, and we built that chapter. We also wanted to add some information about ESG, investing, socially responsible investing, and some other new techniques that have come out over the years.
That's great. Jeff, what are some of the key points that you make in this book?
I think for me, the first one is that it's imperative to do some planning. I mean, we see in the book what can happen when there's no planning involved.
Mm-hmm.
With this group of people, executives and entrepreneurs, they generally have wealth that's tied to the success of their companies. So they need to plan for multiple things. I mean, sometimes some plans where the company does well and others where the company doesn't do as well, like Goliath.
Yeah.
We also think that it's best to do goals-based planning, which I think you're going to touch on in more detail a little bit later. Goals-based in order to give you a better chance at success, and an advisor to lead you in the process of setting those goals, help you to determine the best strategies for your situation, and really important, monitoring the situation and making adjustments along the way. And then I think finally, one thing is there's just no perfect plan or strategy out there, for everybody. Every situation is different, and strategies that might work for one person might not make as much sense for somebody else. I kind of make a reference to cocktail parties when a client comes and tells me that I heard that I should move to Florida. They don't really know why, but they should definitely move to Florida.
Yeah. That's funny. Yeah. So before we get into how to do it, I'd love to hear what financial independence means to you as highly successful financial advisors and authors of this book. Dina, would you like to take that one?
I'll start with the simple. We're given, each individual has two clear limitations in life: the time they have on planet Earth and the capital. And to me, financial independence is about ensuring that, I can spend my time the way I want to, and still take care of my family, my causes, and other responsibilities I have. But ultimately, it's protecting my time. And if I choose to work the dickens because I want to at a certain point, that's up to me. But I want to know I have choices. And that's what my clients are looking for, is choices.
Jeff and Michael, do you guys agree with that?
Jeff?
Yeah.
Yeah, just not having to worry about, maximizing your employment income anymore as far as this group goes. And that can mean different things to different people. For some, as Dina said, for some it might mean fully retiring and just traveling around the world. And for others, it means just taking on a less stressful, lower paying job and having more flexibility. So yeah, just having more choices, as Dina said.
Yeah, in the book, the way we shorthand it, this concept of financial independence, which serves as the second pillar of financial planning, achieving financial independence. This whole concept, it's simply stated as such. It's the point at which you're not necessarily going to retire, but you could retire. It's the point at which you have what you need to achieve your goals in life. Doesn't mean you're going to stop, because many people see their job as something much more than the opportunity to achieve financial independence. It's just when you're at that point, you can do whatever you want.
I love that. Hopefully I'll be getting there soon. Throughout the book, you reference the 5 pillars, which are 5 interrelated goals that executives should focus on to support a state of financial peace of mind. I'd love to dive further into that. Michael, what exactly are those pillars, and how should executives think about these goals in relation to their financial planning and achieving financial independence?
Yeah, I hope that the people who have read the book or will read the book can appreciate that we tried really hard to make sure that we were taking, as you described it, this not easily digestible or reducible to a single formula, amorphous mass of rules and considerations, that we tried to make it easy to understand and to digest. And one way we did that was through the story of David and Abby, and talking about their trials and tribulations as an executive and an entrepreneur. Another was through this construct of the 5 pillars. And the 5 pillars of financial planning for executives and entrepreneurs are maximizing the benefits of being an executive or entrepreneur. And this means looking at benefit structures and compensatory structures and equity incentives, and just thinking about all the things that are available to an executive or an entrepreneur that some executives and entrepreneurs, frankly, are too busy to think about. That's the first pillar. The second is achieving financial independence and how to do that, which is what we just talked about. The third is planning for taxes. Taxes pervades everything in an executive's or entrepreneur's financial life. The fourth is planning for others. And planning for others can include estate planning, philanthropy, all the other employees, all of the other constituents that an executive or entrepreneur might have. And the last pillar, the fifth planner, is minimizing risk. We have to think about risk not just from an investment perspective, but also from a hazards perspective in terms of the use of insurance and limited liability structures. Also thinking about risks in terms of legal risks. Executives and entrepreneurs often face heightened legal risks, and thinking about all these risks and coming up with strategies to mitigate those risks. Those are the 5 pillars.
Thank you. I love the way you've broken down these like concepts into really easy, like 5 steps, 5 pillars. It's throughout the book. You guys have done a really remarkable job, and we'll get into that a little bit further. I did want to ask a little bit more about goals-based financial planning. How does that differ from traditional generic financial planning, and why are goals so critical to achieving financial independence, especially when it comes to an executive or entrepreneur? Jeff?
Well, thanks. I had to think about this because I've been doing goals-based financial planning for so long that I had to think about what the traditional approach was again. And I guess that's just save as much as you can and hope it works out, sort of a thing. So most people, they get it, that their job, their career is a means to achieving certain objectives like retirement. And even in the book, our characters, David and Abby, made progress. They saved money into a 401k. They bought a house. They accumulated some assets, but they absolutely had no idea how they were doing or what the risks were that were out there. So instead, when you set goals that are important, the asset accumulation becomes just a measure of your progress towards those goals. So it can be a more holistic approach where for each goal you consider the 5 pillars that Michael just mentioned, how best to fund it from your compensation, how it affects your cash flow, tax strategies that you might employ, managing risk, everything. So, and I think setting goals also creates a greater sense of ownership and motivation towards achieving them. And I mentioned this a little bit earlier, but I think really important is it includes a system of monitoring and adjusting the plan, because you should absolutely expect changes along the way. Had they set goals, David and Abby may have changed their habits a little bit along the way. They may have not spent so much money, including a country club membership, if they knew that it decreased their chances of achieving things like financial independence or paying for college for their children.
So just like seeing your goals, I guess, spelled out can really help somebody then take action to achieve those, as opposed to just kind of having them in the back of your head as like, one day we want to send our kids to college. It's like,
Yeah.
you want to
And Emily, often you're dealing with 2 people.
Okay.
So whether you could be single and it's only your own goals, but part of the financial planning process is to get things out on the table between both members of the household. And so that can sometimes create some opening of conflicts that are simmering underneath or coming to agreements. And when there's agreement and if both parties are for it, there's much more chance of actually accomplishing the goal.
Another way to think about goals-based planning is it's the why. We can talk about the what and the how all we want. Well, you need to have life insurance. You need to have some sort of education funding account. You need to have an irrevocable life insurance trust. You need to have money invested in the S&P 500. Well, really? Why? Goals-based planning is asking why. It's doing what's necessary to achieve specific goals. That's the why, and not just applying some sort of broad-based, here it is, without asking these questions.
And I imagine, at least for me, reading the book, one of my biggest takeaways was that finding a trustworthy, goal-oriented financial advisor is kind of key to achieving financial independence. But you do note in the book that some people like to go at this alone. Dina, how much harder is it to achieve financial goals without an advisor? Clearly, your book offers a lot of guidance, but it seems to me, at least, that an advisor would be necessary.
Well, I never like to say a blanket anything, and it really depends so much on the individuals. And so the way I would view it, somebody who wants to go it on their own, let's say they are very competent, very disciplined, a great reader, doing everything from their point of view, they're probably on a good track. Even better if they have access to state-of-the-art technology, which may or not be so as great as it should be at the consumer level. But what I find, even for myself, is, and I tell this to clients all the time, you need somebody around you to question your own self. Having an independent party throws something into it to make you question and to think about it. Perhaps they're wrong. But if you have professionals, and even my entrepreneurial clients who have closely held businesses, I convince them to get outside boards of people who can help them think through. And on whether it's focusing on your personal finances or the greater finance of you and your closely held business, outside information is, you're looking at it from your perspective. And Whether you need continuous guidance, you may not, but being able to have somebody, it's sort of like how much of a medical exam can you do on yourself? There's
Yeah,
a point where you need to see a professional.
that makes sense. I like that analogy.
I mentioned in the foreword this research that Fidelity Investments did several years ago, where they specifically were examining corporate executives, which can include entrepreneurs, but can also be more specific than entrepreneurs. We do talk about that distinction in the book. And the research that they had uncovered said that just under 70% of all the executives they surveyed were working with third-party advisors. And as Dina just said, in some cases, you don't have a choice, because it's the rare executive that's going to understand, for example, GST taxation, and also understand incentive stock option taxation, and also understand the fine arts of portfolio construction, and also understand the nuts and bolts of philanthropic planning, et cetera, et cetera. But there are many corporate executives that do want to go it on their own and coordinate all of that and bring in advisors only as necessary. And when we were writing the book, we wanted to be certain to thread another needle, which is we do not want to come across saying that you absolutely have to have an advisor for everything. Just trying to be objective and say, for certain things, make sure you have this level of expertise, because you don't want to go it on your own. And I'm going to say this as well. I'm the CEO of an advisory firm. I have an advisor for many things, because I need someone who has expertise beyond my own expertise. We all do.
Yeah, definitely. I really love how your book gives both a macro view and granular specifics of all the topics that are integral to financial planning. As wealth advisors, do you have a particular philosophy about how to approach topics such as investments, taxes, and estate planning with your clients? Jeff?
I actually work in a similar fashion to how the book is laid out. I like to start with the big picture and then get more into the details. So, for example, with the book, David and his Goliath company stock, I first need to get him to agree that it's prudent to reduce his exposure to Goliath stock, and only then can we start a discussion on how we're going to do that. What shares are we going to sell? In which accounts are we going to do some selling? Should we donate any shares? What are the tax implications? And then what's our investment plan for diversifying the proceeds? And ultimately, how does this affect his progress towards his goals? The most importantly, right? So yeah, I have to get that general buy-in first before really going down to the detailed level.
In your book, you offer 5 steps for investment planning. Michael, can you walk me through those steps, and why is planning so important for an investment strategy?
Sure. Well, that's right. We did. Again, I'm oversimplifying to some extent, but we think a helpful construct is to think about the steps in 5 different segments. And it should not surprise you that the first step is setting goals. It all starts with goals, thinking about things like retirement or buying a home or education. These may sound basic, but it has to start with the specific goals of the particular executive or entrepreneur. From goals, we now have to look at risk. We have to assess the risks. That's the second step. And assessing risks means looking at risk tolerance, thinking about risk through the lens of the particular individual. What I might perceive as risky, you might not perceive as risky, Emily, or vice versa. And so these are not always objective assessments. Sometimes they're subjective as well. So it's looking at risk as the second one. The third step is establishing an asset allocation strategy that matches with the goals and also matches with this assessment of risk. From there, we go to the fourth step. And the fourth step is, now that we have our asset allocation strategy, how do we implement that asset allocation strategy? And that involves, what kind of investments are we going to utilize as part of that asset allocation strategy? And the book goes through great detail on different ways of effecting an allocation strategy. And the fifth step can often be to move back to the first step, because the fifth step is all about maintaining, monitoring, and making changes whenever necessary, which brings us back to when goals change. And the way life works is that life does change over time. And so you can think of the 5 steps as just successive steps, but maybe a better way to think about them is almost circular, because typically we're going back to assessing goals again. And even things like risk tolerance can change over time.
Speaking of risks and investments, we actually have a question in that is a little bit more specific towards the investment side of things, asking about ESG and whether investors should expect a lower return from socially responsible investments. I don't think that's the case, but I'd love to hear your thoughts on that, Michael.
Okay, I'll jump on it. Others may have it. Dina and Jeff may want to jump in as well. My answer is, you should absolutely not expect a lower return. In fact, I think that in some cases, companies that follow the ESG rubric, and E stands for environmental. These are companies that are paying attention to the environment and how they behave as part of the world in terms of addressing environmental concerns. S stands for social, and these are companies that are paying attention to social factors. And G stands for governance. These are companies that have good open governance, often with all kinds of governance safeguards. I think that the ESG rubric is one way of assessing the health of companies and their sustainability as companies longer term. That said, again, we always have to be objective when we give answers about investment philosophy. And there is information that suggests that maybe there isn't an advantage. I don't think there's a lot of information, a lot of data that says that there's a disadvantage. I think longer term, and we at the Collin Group think longer term, that ESG offers a good rubric for assessing the sustainability, long-term viability, and long-term success of companies going forward. Dina, Jeff, do you have
Yeah, Michael, I agree with you. I would never want to promise or suggest that the decision-making in screens for socially responsible investing will give you greater returns. Historically, we were actually advising clients that you're going to be excluding certain very profitable parts of the economy, depending on what screens we agree upon that are important to you. What we do hope is that, and anticipate, and some of the research indicates, that these are better run companies. But most of the times, people are looking for socially responsible investing, not because they're going to get greater returns, but they're going to get similar returns and be doing the right things and rewarding companies for doing the right things. So I think that's usually the overriding goal. But time will tell. We'll see what happens with the performance. But I wouldn't say in excess. I could wish for it.
Yeah. Jeff, did you have anything to add?
I agree with Michael and Dina. I think many years ago, putting those types of restrictions on the portfolio, I think it became a popular thought that you were going to be giving up return in order to do the right thing, but not anymore. I think Dina was right on, where I can get a similar or possibly better return while I make myself feel like I'm doing the right thing, and I'm living the life that I want to.
Yeah. Absolutely. And just a reminder to our audience, please, ask questions. You can put them in the chat box or the Q&A box if you have any questions for our.
Yeah, I've got one more thing to add. There are specific trends and very interesting, sub-trends within socially responsible investing. For instance, water, for instance, clean energy. And there may be ways that, versus looking at the generally large cap or, specific, more general asset classes. I think there are rooms for additional investing. The comment I will make is that when, for instance, I had a client suggest that they wanted to invest in a certain clean energy ETF, what was in there wasn't necessarily clean energy. It included lots of other things that she may not want to have invested. So you got to look under the cover, not just accept the description or the title of something. Look under.
That's right. Yeah, and some people even prefer a broader term such as sustainable investing for describing these kinds of investments. And there are hundreds of factors that you could look at, and that ultimately can be a personal preference on the part of the individual investor.
Okay, well, thank you. I'm going to move on now to the tax chapter. Jeff, talk to me a little bit about writing that. How was that for you?
So one of the 5 pillars, very important, but what boring, scary, when you start talking about taxes, people might just stop listening, and hopefully that's not happening right now.
Yeah. No, nobody trying to tune out. Taxes are exciting. I promise.
I don't find it boring, mostly because it's constantly changing.
Mm-hmm.
I mean, there's new tax laws and new strategies are constantly coming up. So there's always a new thing to talk about. But it is important, especially when your compensation includes company equity or you own a business.
Mm-hmm.
And it's sometimes easy to measure the impact from a tax strategy. So if you're talking to a client, you can say, okay, if you do X, you're gonna save $1,000 on your tax bill, and that gets them interested all of a sudden.
Yeah.
David and Abby in the book paid far more in taxes than they needed to. And I can tell you for sure that one of the things I hear most from my clients is that they want to pay less in taxes. Looking at a tax rate is one thing. Oh, I'm in the 24% tax bracket, or I'm in the 32% tax bracket. But when they look at their tax return and they see the dollar amount that they're paying in taxes, that can be a number that they definitely want to see lower. It could be considerable. So it's important, but when approaching this chapter, it wasn't practical to get really deep into specific tax strategies or to get into more taxes other than like federal income tax. We don't want to get into foreign taxes. We don't want to get into every state in the United States, which can be different. Mm-hmm. So everyone has different circumstances. So what's good for one reader might not be appropriate for another. So instead, we just tried to include a list of kind of general tax topics to consider, and maybe to discuss with a tax advisor about how they relate specifically to your own situation, whether it's a good idea for you or not.
You write about the 10 commandments of tax planning, and we're not going to get into all 10, which kind of focus on optimizing, maximizing, planning, different things. But I do want to talk about the last one, which is maintain good tax hygiene. What exactly does that mean, and why is it important?
Yeah, I think the reason we use that term hygiene is because personal hygiene involves certain habits, things that you do every day. And it's also important to get into good habits when it comes to your tax situation. So a couple of things. Keeping good records, we recommend that people keep records for at least 6 years after you file a tax return. Working with a tax advisor can be a good habit to get into. We do have clients that use TurboTax or other tax software, and those softwares are probably better than they ever have been. But we don't really consider that they're a substitute for human thought and human intuition.
Mhm.
Also, a tax advisor should make sure that you are considering taxes when you're making other financial decisions. And finally, they should prevent you from taking any improper positions that might lead to a higher chance of an audit or something. And then I think final habit that's great to get into is running projections throughout the tax year, so you know exactly what to expect when you do file your returns. Or you can also use it to show what the effect might be of employing a certain tax strategy. So two reasons to know. I think we should remember that by the time you file your returns, it's too late. The tax year is over.
Mhm.
And there could be things that you missed out on that could have saved you money. So it's great to keep an eye on it during the year when you can actually make a difference.
Emily, I'll just add in terms of the tax chapter, and Jeff was one of the principal authors of that chapter, and along with Scott McDonald. And the thing about writing about tax is that, as you well know, and I assume our guests know as well, is that the tax rules change all the time. And the trick in writing a book about tax is to write more about general concepts and not worry so much about what the particular capital gain rate happens to be, for example, at any particular time. Identifying what capital gain means, why it's different from ordinary income, for example, but not getting hung up on what the specific rate might be, for example, in 1 year. And we're seeing that right now. There's a decent chance we're going to see an increase in capital gain rates, depending on what happens with this next infrastructure plan after the one that has bipartisan support. And so that was, when we came up with the concept of the 10 Commandments, we were thinking more about concept than we were thinking about the specificity of various tax provisions.
Mhm. That makes sense. I mean, you're right. It's changing all the time, and depending on what state you're in, like it would be impossible to cover all of that in a book. Now, I'd like to move on to estate planning. Dina, what are the biggest myths about estate planning, and what's the real purpose of it?
Well, I'm actually going to start with a myth that's not in the book, but I heard it from a lawyer the other day. And the myth that this lawyer, he's not a trust and estate lawyer, but the myth that he has that's prevented him, a very intelligent person, from doing his documents, is that if he does it, that's like the evil eye and something's going to happen.
Oh, wow.
Nothing is going to happen differently if you do and take care of estate planning. It has it's just an emotional reaction. But a lot of people generally, I hope he is an exception, but a lot of people generally say, okay, estate planning is for the rich, or estate planning is for people who are really old or really ill. That is just not true. Estate planning is for everybody, because estate planning covers what happens if you disappear from planet Earth today. What happens to not only your stuff, but all the people you take care of and responsible for. In those documents, if you have a child, the guardianship of that child, the care of that child is in your estate documents. So I would, please overcome those myths, get it done, get it so it's workable for you. It could be a very simple set of documents. And of course, come back to it every few years. It's also one of the other really important part about estate planning is most of us, if we leave planet Earth, need to still provide income and flow for our families. And so it's the insurance arrangements associated with protecting the people and the responsibilities we have.
And Emily, I would just add that, one common mistake that people make is they think, well, I don't have that large of an estate, and so therefore I don't need to do this. I'm under the exemption amount for estate taxes. And by the way, I'd remind people there are federal rates, but many states have estate taxes. You got to worry about state estate taxes as well. And it's just not all about taxes. Taxes matter. But if you look at how we organize the book, taxes are a big part of our chapter on estate planning. But most of that chapter is not about taxes. Most of that chapter is about the non-tax aspects of estate planning. We would put that under the pillar of planning for others rather than under the pillar of planning for taxes.
Mm-hmm. We have another question in from the audience that maybe can fall, I think it would maybe fall under this chapter in the book to some extent. Why are large funds and 401k plans a problem upon death?
Well, we can touch upon that, but basically there are two types of assets in general that we have in life. Things we've already paid income tax on and things we haven't. And under current tax law, and this could change, if you pass away, most of your assets, all your assets that you've paid income taxes on, like portfolio assets, homes, businesses, under current law, subject to change, they get a step up in basis. So your family inherits it. They don't have to pay income taxes when they receive it. They may have to pay estate taxes. But on 401 items, what we call income in respect of a decedent, that's a term of art, including 401ks and IRAs, and there are other assets in that category. They don't get a step up. So what happens at death is that anybody who receives it will have to pay an income tax as it's distributed to them. And there are tight rules that I don't want to get into in the webinar about when. Mm-hmm. And for people who have substantial wealth, have wealth over the estate tax exemption, there is an interplay where both estate taxes and income taxes can be due on the same asset. There's a lot of good planning around it. We have it in our book, mm-hmm. but it is a complexity that needs to be looked at.
Thank you. I know philanthropy is often overlooked when it comes to financial planning, but your book makes it clear that it can not only be beneficial for tax purposes, but also can help build a lasting legacy. How do you advise younger executives to think about philanthropy, especially when they are at the beginning of their careers?
Well, since I did the philanthropy chapter, I guess I'll jump in, but I'm sure both Michael and Jeff will add. But on a very simple level, when you're a young executive, young business owner, you're making some charitable gifts, probably because it's things you want to do. Maybe it's things associated with your kids, your place of worship. But often it has to do with when you're trying to get clients and you're trying to get close to clients, trying to do and honor them. Then you'll find you're making gifts because your colleagues have asked you to. And before you know it, you've spent a lot of money looking backwards and not really make an impact. And worse, you probably didn't get the best tax results. And you may have to keep really difficult records to prove what you did. So for even people who are only contributing a couple of $1,000s a year, we may actually suggest that they look at creating a donor advised fund. And that's basically creating a fund through a community foundation or one of the major brokerage firms where they generally contribute something that's appreciated in their portfolio for more than a year. And they get the deduction that year they make that contribution to that donor advised fund. And so the idea is they may want to do 3 or 4 years worth of gifts in that and have enough so that they're actually going to get an income tax deduction for it in that year. Because with the standard deduction being so high, many individuals aren't getting on their smaller gifts. And then the receipt, the only receipt they need is receipt of the gift into that donor advised fund, and it's deductible the year you make the gift into the fund. And then the fund can write the checks and take care of everything. And why I really like it, because it ties in, it establishes a budget for your gifts. And if people are coming up to you, your colleagues are coming to you, friends are coming up to you, you have the excuses saying, oh yes, you know, I really want to be very impactful on my gift making. We establish a budget every year for the causes we're interested in. Oh, I really like what you're doing there. I'd really like to consider it for next year's budget. You know, it sounds a little bit more cohesive and organized. You may not always have the choice to do that, but it gives you the opportunity to do that and get more to making impactful gifts that work within your budget.
And Emily, I'd like to jump in and just first of all, Dina did a wonderful job with this chapter. It's a very important chapter. And again, it falls under the pillar of planning for others. But think about our book generally and this concept of, again, personal financial planning, customized, and understanding who our subject is, executives and entrepreneurs. Philanthropy is important to many people, maybe even to most people. It's certainly very important to me, and it's very important to our company, the Colony Group. But executives and entrepreneurs may have an extended way of looking at it. And while it may very well be consistent with their personal values, they may have gone as far as to create mission statements and value statements for their families, and they're thinking about that and about teaching the next generation. And then there's also something to be said for their businesses. There's a lot of learning on the topic of what makes companies successful. And often one of the factors that makes a company successful is their involvement with their communities. And that in turn can put even more pressure on an executive or entrepreneur to participate in the world of philanthropy. So it's a very important topic for executives and entrepreneurs.
Absolutely. Throughout the book, you offer readers these very tangible bite-sized lists and charts that can really carry someone through the entire process of financial planning. And I'm wondering how those charts and lists kind of came to be. How are they created? What was the process like around that? Michael, you want to take that?
Sure. We understand the reality of reading a book, especially reading a book published by an academic publisher. We love Palgrave Macmillan, but Palgrave is actually quite adept at utilizing visuals because they know that often the material requires it. It's just the reader is looking for those things, and to some extent, we follow Palgrave's lead on this. But we wanted to make sure that we had lots of pictures to make it an easier read for people. And those were, in some cases, visuals around the planning process. In some cases, we use visuals, classic visuals, such as the periodic table of returns, which demonstrates over a multi-year period that certain asset classes replace others in terms of their leadership, in terms of performance. In other words, some years, large cap domestic equities will be the top performer. In some cases, emerging markets will be the top performer. And in other years, it will be fixed income or cash for that matter. And those are things that we think are better shown visually, so we did. In other cases, for example, on our chapter on negotiating employment agreements, many of the visuals are simply excerpts from a fictional employment agreement, where we show what language could look like in a particular employment agreement. So it just depends on the different chapter.
I feel like those examples, like especially with the agreement and those types of things, are so helpful for someone like me reading the book, because it really lets you see what to expect in a way that I've never seen a financial book kind of do before. So bravo to you guys for that. I'm curious, there's a lot of authors that all work together on this book. So what was the process like of working together to make this book happen?
Yeah, well, it started with a desire to do what we believe at our company, which is to do something together, to collaborate in a way where we could harvest the specific expertise and experience of experts that have focused in different areas from time to time. So for example, I'm looking at Jeff, and Jeff is an all-around advisor, but he happens to have very deep expertise in tax. So it's the idea was to go and assemble a team first, and we did. We assembled a team of 11 people, and we all have different expertise. And we decided, we worked on an outline of what we wanted to cover, what the construct of the book would be. We all agreed we wanted to tell a story. And we divided it up, and we each wrote our own chapters. And then the real fun begins when you try to put it all together and make it all sound the same, make it all sound like it's written by one person, which we did. And that meant harmonizing different writing styles, but ultimately making everything consistent. And while I will admit it was a challenge to have 11 authors, I think ultimately this book could not have been written by one person.
Yeah, I can see that. There's a lot in it. We have time for really just one last quick questions, and I'd love for all three of you guys to answer this. Jeff, let's start with you though. What's the number one thing that you hope readers take away from this book?
Oh, I think it's something that we've talked about already. It's you need a plan, and you need to plan for things going wrong along the way, and you need to review and adjust that plan along the way.
Dina, what about you?
I love the way Jeff answered that question. And I'll add, you need the input of other people to make the best decisions. You don't want to end up like an example would be a BlackBerry. What happened to BlackBerry? You really need some input to help you think different.
Michael, do you have anything else to add to that?
Yes, if you have a heart condition, you need to immerse yourself in cardiology. You need to work with cardiologists, not neurologists, and not immerse yourself in neurology. And ultimately, it's the same thing when it comes to the science of financial planning. If you are an executive or an entrepreneur, you need to immerse yourself in planning around executives and entrepreneurs, not something generic and not something focused on other people and people who have different circumstances. Just as someone who, again, going back to my medical analogy, if you have a heart issue, by all means, see your general practitioner, and your general practitioner will guide you to the right experts. But ultimately, you have to understand this concept of personal financial planning. It should be customized for you, the individual.
Thank you so much. This has been a fabulous conversation. I loved reading the book. I learned so much, and I've learned even more this afternoon with you three here today. I want to say a big thank you to our audience. Thank you guys for joining us. Thanks again to Jeffrey T. Craig, Nadine Gordon-Lee, and Michael J. Nathanson from the Colony Group for joining us. And please, if you haven't already signed up, click the link in the chat to sign up to receive a complimentary copy of their book. And check out all of our great content on worth.com. And I hope everyone has a great, lovely day, rest of the day. Thank you guys again.
Thank you.
Emily.